Chapter 22, Budgeting. And you are officially over the hump. This is a really important chapter, and it's something that affects you in any kind of organization that you are active in. That if you have any planning that's done in there, it's done with the budget. Okay, that's what a budget really is. What do we think we're going to sell next year? Um, what are our expenses going to be? What do we want to happen next year? That's all part of budgeting. So we've got 5 objectives in this chapter, and we're going to start out describing budgeting and its objectives and how it affects behavior, and then look at the basic elements of the budget process. 2 major types of budgeting and computers. And then we'll describe a master budget and actually prepare a basic operating budget for a manufacturing company, and then finally the financials. Okay? So budgets are important in all organizations, and big ones as well as small ones. Budgets are used in managing the operations of all government agencies, churches, hospitals, and all nonprofits. Okay, and actually it's more important for them because they don't have the ability to go out and get extra cash. Their cash is limited. And this chapter describes and illustrates budgeting for a manufacturing company. So it involves establishing goals, figuring out your plans to meet your goals, and then every now and then comparing the actual results with the goals. Okay? So we establish goals, we figure out plans to achieve the goal, and then we compare our results with the goal. That makes sense, right? And what is that? That is planning, directing, and controlling. Planning involves setting the goals to guide decisions and help motivate employees. Directing is putting the decisions and actions into action, okay, to achieve the budgeted goals. And a unit of a company, a budgetary unit, is called a responsibility center. And each responsibility center is led by a manager who has the authority and responsibility for achieving the center's budgeted goals. Okay? And then for controlling is comparing actual against the budget. So controlling is running a report and saying, this is what we planned on, and this is what actually happened. And now these comparisons provide feedback to managers and employees about their performance, not necessarily negative. Okay, you might find ways that you've got to improve things. And if necessary, responsibility centers can use the feedback to adjust their activities in the future. Okay, so plan, direct, and control. And that really is what management is. Okay, that's what managing a company is really about. Okay, so what happens is we plan, we direct, and we make it happen, then control, and this is actually feedback back into the planning process. Now, human behavior is actually a field of study in in accounting, if you were going to get a PhD in accounting, which I know you're all thinking about. And the problems can arise because if the goals are set too tight, okay, or too high, then it's really hard or impossible to achieve, and they lose their motivation. Okay, if the goals are set too loose and they're very easy to achieve, they won't be motivated either because they don't have to do anything to achieve the goal. And if budgeted goals conflict with the objectives of the company and the employees, then we've got real problems. Okay, and you've probably all worked in places where all these things have existed. Now this is a good like their illustration of it, and this is in the textbook. But these are goals that are too tight; you can't possibly make it. If they're too loose, it's too easy to get over. And if you've got conflict, you just can't do it. All right. If it's something that maybe you decide you've got to leave the company. So if budgeted goals are viewed as unrealistic or unachievable, it'll have a negative effect on the company. And attainable goals are more likely to motivate employees and managers. So it's important for employees and managers to be involved in the budgeting process. That's what that means. Okay, to bring people in from lower down in the organization and get them involved in budgeting. Budgeting can take a long time. It can take maybe 5 months to put a budget together for a big organization. But involving employees provides them with a sense of control and thus more of a commitment in meeting budgeted goals. Makes sense, right? although it's desirable to establish attainable goals, you don't want to make them too easy. All right. And what happens if they're too easy, then what people do is they build in budgetary slack. They'll pad a budget because there's a lot of game theory that operates in budgeting, and you'll set a budget knowing that somebody's going to come and cut it. So what you do is you build in extra expenses. And managers may plan slack in their budgets to provide a cushion, okay, just like that. And slack budgets create inefficiencies by reducing the budgetary incentive to trim spending. And it's a big game and it's difficult, but keeping right on top of your expenses is important. But then on the other hand, if you've got a boss that comes along and every year he's going to cut the budget, then you're going to build some slack in there so you know what you've got to cut. It's just the way it works. And then goal conflict occurs when the employees or the manager's self-interest differs from the company's objectives. Okay, that is a tricky thing to navigate. Now, budgetary systems are they operate for we use the budgetary period for operating activities is usually goes along with the fiscal year of a company. And for control, annual budgets are subdivided into shorter periods of time. So we look at quarters for sure, or months, or maybe weeks, okay, depending on the business. And a variation of fiscal year budgeting is called continuous budgeting. So we've got a rolling 12-month window there. So say when January this year ends, we go into January the following year and add that to the budget. And the 12-month budget is continually revised, okay, by replacing the data just ended. So we're always looking at a 12-month period. And this is a pretty good example of it, okay? So we get February's over, we get rid of February, and then we go through January to February the next year. Okay, so you're always looking at a 12-month window. And developing an annual budget usually begins several months prior to the end of the year. Okay, and several months, easily 5 months. And the responsibility of developing an annual budget is normally, assigned to a budget committee. That's not how I've ever seen it. It usually comes in, it's something that's directed by the controller. Okay, the treasurer is tangentially involved and the production manager, but you consult all these areas for information, but the controller's in charge of it, okay? But hopefully I won't give you a multiple choice question that asks about the budget committee. And the budget process is monitored and summarized by the accounting department, all right, which reports to the committee, to the controller, really. Can't even imagine a committee doing something like this. And there are several ways of developing a budget, and this is a handy thing to know. And sometimes company will use a variety of these. I'm going to start with this one first. A more common approach is to start with last year's budget and just put changes in. So we take whatever we did last year and we take away the things that only happened for that year, and then we put in expected changes for this year. Okay? And two major budgets that use this are a static budget and a flexible budget. And another way to do it is a zero-based budget. So what you do is you wipe everything out and you make everybody justify everything that they're putting in the budget. Okay, that's zero-based budgeting, and every now and then you should do that. You want to clean everything out and start all over again, because what happens is that there are dollars that build up in here that really aren't being spent. Maybe the way you intended, maybe they get reclassified at some point in the year, but it's just a good thing to do, especially in governmental accounting. With university accounting, when I saw the first budgeting presentation that I went to for a university, they just took last year's and they only even talked about the changes. Nobody goes underneath it and looks at all of those line items again. And that's a huge mistake. Now, a static budget shows the expected results of the responsibility center for only one activity level. And once you figure out, okay, I'm going to produce 2,000 units, it's not changed, even if what you're going to produce doubled. However, this is used mostly by service companies, okay? Service companies and government entities mostly, they'll do a static budget. Manufacturing can't. Okay, you've got to do one that allows for changes. Some functions of manufacturing company like purchasing, engineering, and accounting. In other words, these functions have pretty flat budgets. They're not affected by volume changes. And a disadvantage of these budgets is that it doesn't adjust for changes in activity level. And here's an example of a static budget. This is some example. Okay, so it's Collier Manufacturing, and they've got direct labor and power and supervisor salaries, $60,000. That's what they're going to spend. So there's no adjustment here for volume. Now, a flexible budget shows expected results of a responsibility center for several activity levels. So you estimate what you think is going to happen, then you might go a few percentage points up and then a few percentage points down. Okay, so it's like a series of static budgets for a different level of activity. And what you do for the flexible budget, first of all, you figure out the relevant activity levels. How much do we think we're going to produce? Then you identify the fixed and variable cost components of the costs being budgeted. So we put the variable ones on the top and the fixed ones on the bottom, and we change the variable ones, okay, for the changes in volume. And then prepare the budget for each activity level by multiplying the variable cost per unit by the activity level and then adding the fixed costs. This is easier to do than to read about. Here's an example. This is actually a pretty good example of a flexible budget. So we have three levels. Units of production are 8,000, 9,000, and 10,000. And see how the costs over here are broken down between variable cost and fixed costs. So these costs change depending on how much we're going to produce. So you can see how direct labor increases, which makes total sense with the level of production. And then electric power also increases. Okay, so you've got a production department that uses a lot of power. Now, fixed costs, this is the fixed piece of electric power, $1,000 a month no matter what. Supervisor salaries are there for $15,000 no matter what. Doesn't matter what the level of production is. So we've got total variable costs plus total fixed costs, and there's our total department cost. Okay. Now, because the flexible budget adjusts for changes in the level of activity, it's much more accurate and useful than the static budget. I mean, if something if the budget is off because the production is off, then that just doesn't, it's hard to hold people responsible for that, for things that are out of their control. Okay. Now, here is an example of a static and a flexible budget. We've got our static budget showed $60,000 budget, but the actual results were $70,800, so it's over budget. Okay, but then you've got to go in and see why and everything and explain it. Whereas for the flexible budget, they're on the budget, we've got 8, 9, and 10. The actual results are 10,000. Oh, 71,000, 70,800. So it's $200 under. So we can compare these two. We can compare the 10,000 or the 71,000 and the 70,800. The numbers in here are close. So we can actually look at these differences because the units are the same. Okay, not the dollars so much, we're really looking at the units. Does that make sense? Okay, this comparison right here is apples to apples. Over here it's apples to oranges because you've got two different volume levels. Okay, last slide. Here's an example. At the beginning of the period, the assembly department budgeted direct labor of 45, supervisor salaries of 30,000 for 5,000 hours of production. The department actually completed 6,000 hours of production. Determine the budget for the department, assuming that it uses flexible budgeting. So we figured out if you took the 45,000 of budgeted direct labor hours and divided by 5,000 hours, we get $9 per hour. Okay, that would have been the budgeted number for direct labor. So they actually completed 6,000 hours. So I could take my direct labor of $6,000 times $9 and get $54,000, then add my fixed costs, and this would have been my total department cost of $84,000. Okay, that's a flexible budget. And the thing of it is that it's tied to the units produced. In this case, it was direct labor hours. Okay, that is it.